Well now, I'm growing a horn out of my forehead. How are you doing? Also, this guy is back on the front page of the US market news, and that means bad news are still ahead. So here's what's going on. Last week, Bank of America published a crazy report that scared the markets because they're claiming we are going through one of the biggest bond bubbles in our history. And they looked at data as far back as the year 1790. That's right, the year 1790. And now they're calling this the third great bond bear market in our lifetime. And that's because the global bond market has already lost $1.2 trillion, and that's only been in 1 week, because so far the year-to-date losses globally in the bond market are over $12.2 trillion. And the closest thing that we have ever experienced to what's going on right now was in the year 1949. And this is not just happening in the US, this is happening globally in places like the UK, Germany, and France. Now, even if you're somebody who, like me, does not invest in bonds, doesn't follow the bond market because you're like, bonds, I'm way too young for the bond market, I just don't care. This is still extremely important because how well bonds do has a huge effect on the stock market. And this is because bonds represent what are called fixed income assets. In other words, bonds are the safest investment anyone can make because they're usually backed by the full faith of that country's government. And so for the longest time, investors have always had a choice to either put their money into the bond market or into the stock market. So here's what's going on. If we use this bond as an example, BND, this is an ETF version of a mutual fund called VBTLX. So this one bond represents more than 10,000 US investment grade bonds, and this is a big one because it's sort of like owning the entire bond market with this just one bond. So far, the year-to-date bond is actually down 15%. And if you look at its 5-year chart, it's almost equally as terrifying. And because of what's happening to these bonds, this is why the stock market hit a new yearly low. And some people are arguing that because of what's going on in the bond market, the stock market is going to go even lower. Now, it sounds terrifying, but if you actually pay attention and you understand what's going on behind the scenes, it's even scarier. I'm just kidding. So today, I want to break down all of these scary headlines because they are not as crazy and as scary as the media is trying to make it seem. So let me help explain exactly how all of this is interconnected and how this will affect us. So let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for one of the most complicated and crazy videos I've made in a while, but I promise if you stay until the very end, you're gonna learn something new. So first, I want you to understand that this whole bond collapse happened artificially. This was all intentionally played out, and it was done on purpose. If you remember last week, Papa Chairman Jerome Powell increased what's called the federal funds rate. That is the interest rate for banks to borrow money from each other by 0.75%. Now, the US was not the only central bank that did this. There were also 10 other central banks around the world that increased their interest rate for a grand total of about 6% in 1 week, which is huge. Now, when interest rates go up, here's what happens. Bond interest rates also go up, but their prices go down, which doesn't make any sense, right? Because you'd think that if interest rates go up and an asset starts to pay me more money, that it should also become more valuable because more people would want to invest in it. But that's not how it works. All you have to understand about bonds is that their prices move in the opposite direction to their interest rates. So let me use this 2-year treasury bond as an example. This is a very real bond you can buy right now for $98.25, and it's paying us an interest rate of 4.2%. Now, you can buy this bond on treasurydirect.gov. I am not affiliated, I'm not sponsored, I don't get a kickback, but Papa Pal, hook it up, man. So for every $98.25 you invest, at the end of that 2-year period, because it's a 2-year treasury bond, you will make exactly $8.24. More specifically, you will make $2.06 every 6 months because these bonds pay us every 6 months. None of that math is really important. I don't need you to memorize that. I just want you to understand that that's how they work. But once you buy them, you can do one of two things with them. Here's what they are, but first a quick word word from today's sponsor. Now, besides investing in the bond market where you're guaranteed to make a return, the best way to make money in an economy that's going down is to start a business. Now, I realize that's way easier said than done, but that's why I'm so excited about today's sponsor, Trends. Trends is the ultimate knowledge and networking hub where entrepreneurs and like-minded, ambitious people get together to learn, to share, and to collaborate while also learning from the world's most successful executives and insiders. Here's how it works. Once a week, you're gonna get an email with emerging business trends before they get big. This is how one startup called Growth was able to raise $1.5 million in just 40 days, just by being a subscriber of their newsletter. And all they did was they took the data in that newsletter and they used it in a presentation to raise money from their investors. Another company called Get Nutty increased their sales 20x just by posting on their community and asking for feedback and then getting roasted. Not only will it save you hours of research, but you will instantly get access to the Trends community, which contains thousands of like-minded, ambitious business builders. So if you ever wanted to find a mentor, a co-founder, or even investors for your next big idea, this is the place to do it. I highly encourage you to click the link in the description below the video where you can get a 7-day trial for just $1. Definitely go check them out. Thank you, Trends, for sponsoring this portion of the video. Now let's get back to it. So here's what you can do once you buy that 2-year treasury bond. Option number 1, you can wait for the bond to reach full maturity, which is that 2-year mark, at which point you will make all of your money back plus interest. In our case, we will make back all of that $98.25 plus the 4.2% interest or $8.24. This is why bonds are extremely popular, especially among older people, because they are a guaranteed way to make money, especially because the US government has never defaulted on their loans, which is why they're considered super safe. Unless, of course, you go with option number 2. Option number 2 gives you the option to sell those bonds before they reach maturity date, right? That's because you want to make more money faster. But the question is, will that bond be worth more or would it be worth less? The answer to that question depends on where interest rates are going. And we know that interest rates are going to go up, which means future bond prices will continue to go down. And the market knows this because if we look at the CME Fed Watch tool on November 2nd, it shows a 72.9% chance that rates will go up again between 0.5 and 0.75%. Now, what does all that mean, right? That means if I'm somebody who's in the market to buy some bonds, and I want to buy some bonds from you right now, would I pay you $98.25 for your 4.2% bond if I know that I just have to wait a little and I know the government is going to create another exact same copy of your bond for the same price, but instead of 4.2%, it's going to pay me 5%. I'd rather wait. So if you want to sell me your bond, you're going to have to offer me a discount to compensate for it. And this is not a hypothetical scenario. This has been going on since the start of rate increases. And that's how, with every new rate increase, new bonds get created with higher interest rates. Therefore, the older bonds go down to compensate. And this is what the Fed has been doing to fight inflation. So all of this has been 100% intentional and on purpose. I hope all of that made sense. And now that you understand how bonds work in relation to interest rates, let me tie it together on how all of this affects the stock market. All right, so to understand how stocks are affected by all of these bonds, remember when the Federal Reserve told us that inflation was transitory? Pepperidge Farms remembers, because inflation was not transitory. It was very sticky, which meant the Fed had to raise rates to fight that inflation. But the problem is that right now the stock market has no idea how high the Fed has to raise those rates before inflation goes away. All we know so far is that the current federal funds rate is at 3.25%, and the Fed wants to get this number to 4.5% and maybe as high as 5%. But the stock market is not sure, and because there's uncertainty, that's why there's volatility. Now, this is all data that's based on the summary of economic projections, or this dot plot that we talked about before. Now, the current working theory among investors is that the stock market can't and will not go up until the Fed stops raising those rates. Now, arguably an even bigger reason why the stock market is going down and how all of these bonds are interconnected together is because bond yields, aka interest rates, have pretty much matched what you would expect to get as a dividend investor. Now, let me show you what I mean. This is my stock portfolio right here. I'm not showing it to you to show off, it's just an example. Most of the stocks in my portfolio are dividend stocks, and my goal is to have this dividend yield, which is this little number right here, average average 4% across all of my stocks. Now, some of the stocks pay me a little bit more than 4%, some pay me a little bit less percent, but they average to around 3.5 to 4%, and that is the general rule of thumb to aim for among dividend nerds like myself. That is that 4% rule of retirement. Right now, though, you have to remember these stocks are what you call equities, right? Which is a fancy word for stonks, and they don't always go up. I'm taking a risk by investing my money into stocks, and right now they're all going down. Luckily, not as bad as the S&P 500, which means I'm winning, but I'm still down double digits, so it's not saying much. The point is that especially the older you get, the more appealing the bond market gets, because bonds pay you a guaranteed par value. So you get all of your money back plus interest, and that's saying a lot in a market where there are very few ways to make a guaranteed return. That's why especially the older people are starting to sell out of their stocks and moving into bonds. And remember, when you sell your stocks, of course, the value of them drops as well. So all of that is just one reason why the stock market is falling. Now, another big reason, if you want to get really nerdy with it, is because we are not the only ones that want to park our money in the bond market and sell off our stocks. Banks and corporations want to do the same thing because companies park their excess cash into the bond market. But the difference between corporations and ourselves is that companies might not want to wait until that full maturity date because they need access to capital. They need liquidity. They need to enter and exit very, very fast. But remember, if you sell your bonds before maturity date, there's a chance that it's going to be worth a lot less. So if I'm an investor and I'm trying to put a valuation on a company, I would not value it very high if I knew that a lot of that company's assets or money is held in a collapsing asset like the bond market. So that's another reason why the stock market's falling. Another reason is because the Fed, aka the central bank, is expected to start selling off their bond portfolio very, very soon. And they have a massive bond portfolio. So once they start selling, what happens to bond prices? They start falling even more, which means interest rates will shoot up that much more. So all I'm trying to say is that the juicier the bond market gets, as a result of bond prices falling, the more rotten the stock market looks by comparison. I know I threw a ton at you, but I hope now you understand the difference between stocks and bonds and how all of them are interconnected. Now, if you've made it this far, let me give you my personal thoughts on whether it's a good idea to sell your stocks and start buying bonds instead. Now, this is not financial or investment advice. Please remember you're watching somebody random on YouTube that talks about something he's got no qualifications to talk about. But having said that, I did think about converting my entire stock portfolio to a bond that pays me 4.2%. It makes sense. I'd rather make 4.2% now than be losing almost 20% in the stock market. But I didn't do that. And the reason I didn't do that is because number one, I'm still relatively young. Not by YouTube standards, but by investing standards. I still have 20 years on my side. And the reason I say 20 years is because there's a study that took a 20-year consecutive rolling period. And if you applied this 20 years to any point in the stock market's history, there has never been a point where you have had less money at the end of that 20 years if you held your stocks for the duration of all of those 20 years. That's my goal. I want to hold my stocks for at least 20 years because then I know I would end up with more money than I started with. Now, reason number two is because selling my stocks right now is the equivalent of trying to time the market. And it would be just my luck if I sold all of my stocks and then the next year, for whatever reason, the stock market recovered 30%. That means I would lose and I would miss out not only on the recovery, but the rally. So then would I sell my bonds and start chasing overvalued stocks again? Then I would have to time the market again. And it would be my luck that that's exactly what would happen. Now, this is also why one of the most traditional pieces of investing advice that you get is that as you get older, you need to convert a portion of your stock portfolio into bonds. The general rule of thumb is to substitute your age with the percent exposure to bonds. So for example, if you're 30 years old, you should have at least 30% of your portfolio in bonds. Now, there are also critics of this advice because people say the bond market has been doing nothing for decades. And this has been true with the exception of today's environment because interest rates are so high, it makes perfect sense. But for the longest time, the bond market has made very little money, which is why the more modern bond advice is to look at the 15-50 rule, which is that if you think you're going to live for another 15 years, to have at least 50% of your net worth in stocks. Generally speaking, speaking, I have no idea where the stock market is going to go in the short term. In the long term, I know it'll be more valuable. That's why I'm going to continue to stay the course and dollar cost average as usual. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab up to $250 worth of free Bitcoin with this link right here. Don't forget to grab the money while it's still there, but move your crypto offline to a cold storage wallet. In the meantime, don't forget to grab your free stocks. Links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. Bye-bye.